Throughout history, financial markets have surged to dizzying heights, only to come crashing down in the blink of an eye. But with every collapse comes valuable lessons. Lessons that traders, investors and entire economies can learn from. Today, we'll unravel the most infamous market crashes in history, uncover why they happened, how we recovered, and perhaps most importantly, how you can spot the warning signs before the next one hits. In 1929, a dark shadow fell across Wall Street. The roaring 20s had given way to speculative mania, where ordinary people were borrowing money to buy stocks, convinced the market would go up forever. Then, on October 29, 1929, known as Black Tuesday, the bubble burst. The stock market fell nearly 12% in a single day. Over the following weeks, billions of dollars vanished as the market continued its nosedive. What caused this catastrophic event? Speculation and leverage. People borrowed money to invest in stocks, inflating prices far beyond their real value. Lack of regulation. The banking system was weak, and there were no safeguards to protect against reckless speculation. Overproduction and falling demand. Industries produced more than consumers could buy, causing profits to shrink and panic to spread. It wasn't easy. The Great Depression lingered for a decade, with unemployment skyrocketing and global trade grinding to a halt. But change eventually came through bold government action. Franklin D. Roosevelt's New Deal brought relief through massive public works programs, banking reforms and social safety nets. Regulation matters. The Securities and Exchange Commission, SEC, was created to enforce rules that would prevent excessive speculation and fraud in the markets. The dangers of leverage borrowing to invest can amplify gains, but when markets turn south, the losses can be catastrophic. The Great Depression led to reforms that strengthened the financial system and set the foundation for future prosperity. Social security, unemployment insurance, and stronger banking regulations provided stability for millions. On the downside, it wiped out a generation's wealth, leading to mass poverty and disillusionment. The global economies suffered deeply, with effects rippling across Europe, Asia, and beyond. Recovery took years. It wasn't until World War II, with its massive industrial demands, that the global economy fully rebounded. With better banking regulations and a more controlled lending system, the bubble might not have grown as large. But hindsight is 2020, and the speculative fever of the time was hard to contain. Fast forward to October 19, 1987. Known as Black Monday, it was the largest single-day percentage drop in stock market history, with the Dow Jones plunging a staggering 22.6%. Program trading, new automated trading systems created a domino effect of sell orders, amplifying the market's decline. High valuations, stock prices were inflated, driven by optimism in the booming 1980s economy. Panic selling. As markets started to fall, fear spread and investors rushed to sell. Interestingly, the recovery from Black Monday was relatively swift. The market regained much of its losses within months, thanks to decisive action from the Federal Reserve, which provided liquidity to stabilize the financial system. The risks of automation. While automated trading can increase efficiency, it also comes with risks. When algorithms all trigger at once, it can create a self-reinforcing cycle of selling. Quick action can stop panic. The Federal Reserve's intervention helped to restore confidence in the markets. Black Monday highlighted the importance of circuit breakers, mechanisms that halt trading if prices fall too quickly, to prevent panic from spiraling out of control. Though the market recovered, Black Monday shook investor confidence and revealed the dangers of over-reliance on technology without proper safeguards. Unlike the Great Depression, the recovery from Black Monday was fast. By the end of 1987, most of the losses were regained, and the market resumed its upward trajectory. Had there been stronger controls on program trading and better systems in place to halt runaway sell orders, the crash might not have been as severe. The dot-com bubble of 2000. The late 1990s saw the rise of the internet, and with it, a surge of investment in tech stocks. It seemed like a new era until the bubble burst in 2000. Big reasons: overvaluation of internet companies. Investors poured money into tech startups, many of which had no profits, simply because they were part of the new economy. Hype and speculation. The belief that the internet would revolutionize everything led to irrational exuberance. Lack of profitability. Many companies went public with no clear path to profits. How did we get out of it? The collapse wiped out $5 trillion in market value and the economy fell into recession. But over time, companies with real business models, like Amazon, emerged stronger, while the dot-com era's excesses were weeded out. What did we learn? Fundamentals matter. No matter how exciting a new technology is, investors need to pay attention to fundamentals like profits and revenue, the risks of hype. The dot-com bubble showed how easy it is for markets to get caught up in the excitement of new technology, leading to inflated valuations that are unsustainable. Positive outcomes. While the bubble burst, it laid the groundwork for the tech giants we know today. It also taught investors to be more cautious when investing in new technologies. Negatives. Many people lost their life savings and a whole generation of investors became wary of the stock market. How long did recovery take? It took about 2 years for the market to hit bottom and several more years for tech stocks to regain their former glory. But in the long run, the internet truly did transform the economy, even if the bubble burst along the way. Could it have been avoided? Had investors been more cautious and focused on profitability rather than hype, the bubble might not have grown so large. But with new technology, it's easy to get caught up in the excitement. The 2008 financial crisis. In 2008, the world faced its worst financial crisis since the Great Depression. It started with subprime mortgages, but the fallout spread far beyond the housing market. Big reasons: subprime mortgage lending. Banks gave risky loans to people who couldn't afford them, fueling a housing bubble. Complex financial instruments. Derivatives like mortgage-backed securities were created, and when the housing market collapsed, they became toxic. Lack of oversight, banks were over-leveraged, and regulators failed to see the dangers of the housing bubble. How did we get out of it? The recovery from the 2008 crisis was slow and painful. Governments around the world injected trillions into their economies, bailed out banks and cut interest rates to near zero. What did we learn? The risks of too much debt leverage can boost profits, but it can also magnify losses when markets fall. The need for transparency, complex financial products can obscure risk, making it harder for investors and regulators to see what's really happening. Positive outcomes. Reforms like the Dodd-Frank Act strengthened financial regulation, and banks were forced to hold more capital to withstand future shocks. Negatives. Millions of people lost their homes, their jobs, and their savings. The global economy shrank, and some countries like Greece faced years of austerity. How long did recovery take? The stock market began to recover in 2009, but it took years for the global economy to fully heal. Some countries are still feeling the effects today. Could it have been avoided? Stronger regulation of the housing and banking sectors could have slowed the build-up of risk, but once the bubble popped, the damage was inevitable. Market crashes can be devastating, but history has shown us that with time and effort, economies bounce back. While no one can predict the future with certainty, the lessons from these crashes are clear. Speculation, over-leverage, and lack of regulation have all played their part in driving markets off a cliff. But for those who study the past, the warning signs can be seen in advance. Learn from the past. Prepare for the future. If you want to stay ahead of the next big market move, subscribe to Market Matrix for more insights, lessons, and strategies to navigate even the most turbulent markets. Because those who understand history are better equipped to face the future.